German Prelimdex CPI plus 0.4% on month, plus 2.6% on year. German Prelimdex CPI forecast plus 0.3% on month, plus 2.4% on year. DEX CPI plus 0.7% on month, plus 2.9% on year. Germany EU harmonized DEX CPI was forecast plus 0.4% on month, plus 2.6% on year. German bonds slip after inflation.
This is the Daily Market Rundown live from the Tradelo Trading floor. It's January the 6th and some highlights from today's show. Bernanke says Trump won't be inflationary. Wall Street is bullish stocks for 25 and yields rising is not yet a problem for stocks. Good day traders and a happy new year to all of you. Hopefully it is a very successful trading year. Let's begin with some of the overnight news, starting with the Bank of Japan. We've had the governor Ueda come out and tell us that, look, they're still going to keep hiking rates because the economy continues to improve. And they are going to keep this idea or this sort of hawkish stance so long as they see a sustained increase in the wage dynamics. In other words, they want to see people earning more money because they think that will lead to an increase in demand. Now, this is nothing new necessarily. We've, of course, seen the Bank of Japan adopt this stance for some time now. And it does, of course, lean on the idea that we've got to keep paying attention to wage growth in particular in Japan, because that's ultimately going to signal when those future rate hikes do become likely from the BOJ. Now, turning to our first topic, it's all about Ben Bernanke, and Ben Bernanke has come out and he's told us that, look, Trump 2.0 is not going to prove as inflationary as expectations. And he's listed three reasons for that. He started off in saying, well, look, if we take a look at some of the expiring tax cuts that was expected, that was going to happen regardless. They were going to be extended regardless of who came into power. And so he doesn't believe that is necessarily something new for forecasters to be concerned about. He's then gone on and said, well, look, yes, he's going to be very much clamping down on a lot of the migration that's happening into the US, the undocumented migration. And as a result of that, sure, there may be fewer people in the labor force. We know this was a theme last year where, we had ultimately, fewer, or at least we weren't seeing any significant uptick in the unemployment rate as a result of more migrants being capable of working. And the result is Bernanke saying, well, look, sure, maybe we'll see a little bit of an uptick in wages, but at the same time, if we're deporting a number of people, that will reduce demand on the other side of the equation. So null effect as a result of that. And then finally, he said that, look, at the end of the day, the tariff situation, if we look at 2016, which was Trump's first presidential go at it, very much he did talk hard on tariffs. He did impose some tariffs, but the reality on the ground is he used them mostly as a weapon. He used them mostly as a bargaining tool where he said, look, either you buy more of our this and that, otherwise we're going to impose tariffs. And the result was he pretty much got what he wanted in most situations. Okay, sure, some tariffs were imposed, but the result of his first presidency was it was not inflationary necessarily from a tariff standpoint. So that's what Ben Bernanke's case is. He's saying that, look, it's not doom and gloom. We're not going to see significant inflationary pressures as a result of Trump 2.0. Now, turning our attention to some of the overnight market moves, we can see there's two key things that stand out. One is the dollar. Okay, the dollar has been sold off early in this year. Is this anything significant? No, it's just a little bit of profit taking on the recent dollar strength. Keep in mind, we have seen the dollar charging now for some time. Why? Well, the Fed's the only one that's sitting with very elevated real rates, whilst every other central bank is cutting interest rates. In other words, there's a big rate differential between the United States and everyone everyone else, and that means you've got to own the dollar. Now, this is going to be a theme throughout 2025. Everyone on the street is very bullish the dollar, and rightfully so long as the US economy remains exceptional, so long as growth stays up around that 3% mark, it's likely we're going to see that dollar continue on the bid side. So looking early, we of course have got the euro up 1%, 1 and a bit percent. We've got the pound up just shy of 1%. And this is very much just a little bit of that theme of profit taking. Don't be surprised to see bears reinitiate those shorts in the euro around that 104.50, 105 marker. There's some really good resistance coming in there, and we'll talk about that in a moment. Now, let's segue on to our next chart, which is the our next theme is the bullish Wall Street. So looking at Bloomberg, they've provided this. It's all about some of the forecasts for 2025, and the street is very bullish. I think that's what you need to know as a trader. Everyone at a consensus is extremely bullish. Even if you look down the list, all the way down to Mike Wilson, who we know has become kind of famous for being the last bear standing. You know, he's even talking about a 10.5% rally in 2025. Now, if we look historically, what should the S&P do on a year-by-year basis? Well, roughly speaking, around 10%. That is the historical average of gains over the last 50-odd years. So 10% is kind of a median expectation. It's quite normal. So we can see most of the street is either forecasting a good year or a normal year, but we have got some analysts talking about a better than expected year. Now, again, we'll talk a lot about this over the course of the year, but the key takeaway from this is that everyone's bullish. Okay, there's no one really calling for any kind of a down move or a flat year or a negative year, and that tells us that the street's bullish. Why? Well, because like I said, the US is exceptional in terms of their growth expectations. We've got Trump coming in that's very much going to remove a lot of regulation, and that should spur more of this kind of growth. Okay, it's very much a growth-led story, and I think that's why the street is rightfully very bullish. However, and this is a caveat, we do have a Fed that came out in December that said, look, we're only thinking we're going to cut twice this year because we need to see more evidence that inflation is coming back to target. Now, should inflation remain sticky, should inflation tick back up, that is very much going to challenge this growth thesis that all these forecasts are built upon. So keep a close eye on that. Right now, however, it remains a very bullish Wall Street. Now, let's move across to one of our key charts. This is a theme that's going to be ongoing throughout this year. It was a theme that sort of developed late in December, and it's all about yields. Now, there's been some talk about why are higher yields not leading to more risk-off scenario? Why is the VIX very much being squashed? Well, the reality on the ground is that, sure, yields are moving up, but it's back-end yields that are moving up, and we can see that in the green. You can see since that Fed meeting, which is that vertical line there, you can see that the back end has gone from 440 to 460. What has the front end done? Well, the front end's gone down, okay? And this is the key. For this to be a problem for ultimately the stock market, you need to see front-end yields moving higher. Why? Because ultimately that suggests that we do have perhaps a more hawkish Fed incoming. Now, the back end moving higher, what is that telling us? Well, it's telling us everything we need to know, which is we've got a strong economy in the US. We've got an economy that's running hot, and we do also have a president that's coming in that wants to increase that momentum. So this is very much showcasing a very strong performance in the US economy, which is why it's not bearish for the stock market. Keep a very close eye on, should we see that 2-year yield pop above 440 and sustain that break? Yes, by all means, then we can start to talk about a scenario where equities do come under some sell-side pressure. Until then, so long as the steepen is being driven by the back end and not the front end, all is okay in stock market land. And then let's finally talk about our play for the day. It's very much looking at that euro. Like I said to you, we've got a very, very significant area at that 104.5. You can see that purple line, which is the 20-day average, really does showcase that euro is in a very strong downtrend. Now, like I said to you, you can see that we've been on a hard offer for most of Q4. We drove down from 112 all the way down to 102. I mean, that's a significant move in terms of the pace and the speed of that move. Why is it happening? Well, like I said, ECB is set to keep cutting where the Fed is now paused, and and they are potentially likely to pause for some extended time this year, and that's resulted in the euro selling off. However, markets don't move in straight lines, and that's why this bounce is very much expected. A little bit of a reprieve in the euro, but we are now at R1 at 104.50. Keep a close eye on that. We didn't get above there earlier in late last year, early start of this year. You can see it was a very key support area for Q4 2003. It held quite significantly. We did snap through there first time, consolidated below it, and then sold off. So the market has leaned on this. Should we pop above there? Does it change the thesis? Does it make you any less bearish? Of course not. It just means that our resistance comes in at 106, and you can bet your bottom dollar there are a lot of investors, institutions that are just looking to be short euro against the dollar in the near term. All right, that then is a wrap for today. In terms of key economic data, there's not a great deal going on. We had quite a bit of European data out this morning, so that's now passed through. We've just seen the inflation come out of Germany slightly hotter than expected, which is also adding to that bullish euro for the day. However, the key data is coming out tomorrow. We've got some JOLTS data from the US as well as the PMI data. And then the big data point, of course, comes at the end of the week via the non-farm payrolls. That's it for today then. Good luck out there. Always manage your risk. Go make some money.